Morning, everybody, and welcome to the third in this series of our webinars. The series has been about the role that AI will play or is playing in advice, portfolio management, and investment management. And we distinguished between portfolio management and investment management because it seems to me important to think about the opportunities which AI provides to portfolio managers running managed account portfolios for individual clients. And we covered that yesterday with Socrates Vassos, Michael Strachan, and Stuart Elliott. But today, we're going to be talking about AI in investment management, in funds management. We're going to be talking about the way in which AI is being used by fund managers, and also the investment opportunities that it gives rise to for equity managers. As with Monday and Tuesday, Mike Taylor, the editor of Financial Newswire, is the moderator for our session today. And before I hand over to Mike to introduce our panelists for today, let me just say a little about our upcoming events over the next couple of months. We're continuing the theme of portfolio management with the Portfolio Management Conference in March in both Melbourne and Sydney. And we'll be covering a broad spectrum of issues, macroeconomic, geopolitical, and asset class specific, and the ways in which they're influencing and being accommodated by portfolio management for managed account portfolios. And we're following that each day with a conference on direct indexing and the part that it might play in providing services to retail investors. This is an area of emerging interest and one which we're happy to showcase after the Portfolio Management Conference. Then in July, we'll turn our attention again to advice practice, the way in which advice businesses are evolving in our Advice in Action conference. And again, that'll be followed by a masterclass on building retirement income portfolios. And finally, before I hand over to Mike, I'd like to just remind you about the IMAP Managed Account Awards. We cover the most important categories of awards: licensee awards, boutique licensee, a new category, responsible investing portfolios, and then the asset class portfolios: Aussie equities, small caps, fixed interest, global equities, and multi-asset class. I'd encourage you to enter. You'll find that the process of entering is worthwhile, and we'll look forward to being able to showcase, as a result of that, best practice in the way in which portfolios are developed. I needn't remind you of how to ask a question. We've had some great questions on Monday and Tuesday, and I'd encourage you as we go through today's session to send in those questions. So now, Mike, it's my pleasure to hand over to you.
Well, thank you very much, Toby, and good afternoon, everyone, and welcome to this, as Toby said, the third and final segment of the IMAP webinar series dealing with artificial intelligence and its implications for the financial services industry. We, of course, started off looking at the uses of AI for financial advisors, and yesterday we looked at AI in terms of investment management, and today we're expanding the theme and looking more at, as Toby said, portfolio management, funds management. And on the panel today, we have Cameron Gleeson, who is a senior investment strategist at Betashares, with responsibility for supporting all distribution channels, assisting clients with portfolio construction and working alongside the portfolio management team. And Cameron brings us strong experience, having been a portfolio manager at Macquarie Asset Management, and before that, head of product at Bell Potter Capital. We're also joined by the Chief Investment Officer of Insync Funds Management, Monik, who will be well known to most of you, having had 30 years of funds management experience, both in Australia and overseas. Monik had senior portfolio manager roles at Investors Mutual, BT Funds Management and as a pan-European equity analyst at the Abu Dhabi Investment Authority in London. So it was a diverse background there. Cameron will be discussing the passive approach to AI as an investment opportunity, while Monik will be looking at the situation as an active investor. As is always the case, we try to make these sessions as interactive as possible. So please, as Toby said, use the Q&A function on the Zoom browser to ask your questions. But to kick things off, I'm going to invite Cameron to deliver his approach. So over to you, Cameron.
Thank you very much, Mike and Toby, for the introduction. So just wanted to sort of start off on where we are now and what we talk to a lot with our clients. If we flick forward just 2 slides there to this chart here where I compare the performance of NVIDIA versus a company that was a darling of the .com boom. Right now, there's a lot of market focus on NVIDIA in particular as really, the poster child for these AI winners within the Magnificent Seven. NVIDIA is due to announce its earnings for last quarter tomorrow morning, 9 a.m. our time. And the market's keenly watching for that announcement. Expected mind-boggling revenue growth, over 370% revenue growth expected out of that company year on year. So just sort of an incredible story of, tailwind from having basically the lead product, which is required for the build out of AI. But it's sort of interesting to look at NVIDIA and compare it to a company like Cisco, because there are some parallels here. Back in the .com boom, people saw Cisco, which produced routers and networking equipment, as really the important and the critical hardware for the build out of the internet. And Cisco became the most valuable company in the world at one time. PE ratio of over 200. NVIDIA's trailing PE sits around about 100 at the moment. So there are some parallels there in terms of that story of that critical hardware, and it was going to lead to the future of a new technology, which we like to see. And we also see that if you look at the sentiment around NVIDIA, you look at positioning of hedge funds and active managers, we do see some very large overweight positioning in this stock. You can see the last point there is that if you look at broker recommendations, 58 out of about 63 or 4 recommending a buy on NVIDIA, only 1 a sell, despite this meteoric price rise of about 400%. So, it's good to sort of pause at these sort of junctions and really take stock of what has happened and whether there is still a good investment case there. So we look to the next slide and thinking about NVIDIA as a stock and its competitive landscape. It clearly has the leading product in terms of their GPUs, which I think it well understood are the critical hardware used to train AI models. And you can see their current market share. They dominate the GPU market. Their H100 chips are market leading, but also what they offer is a really comprehensive software stack that makes their chips very easy to use, and that's why they have such a compelling product. But we are starting to see other companies make inroads, notably AMD, who have cheaper chips that have similar tech characteristics, perhaps not the same software support that NVIDIA provides its clients, but making inroads into this market. And there's no guarantees with any technology that the current leader will remain tomorrow's leader. We're also seeing, companies like Google, who run their own cloud computing business, which is where all of these AI accelerators, all of these AI chips go. And Google are actually producing their own alternative AI chip, which is their TPUs, which now have similar specs too. And it's important to note when we think about who's buying these AI chips, it's not, for example, an AI startup or an ordinary company looking to do AI. It's those hyperscaler cloud computing platforms that are buying the chips, and then that AI company itself is then buying compute and data storage from that cloud computing company. So it's an interesting dynamic. NVIDIA certainly holds a very strong position, but there are no guarantees. And I think just with generally speaking, investing in technology, there are no guarantees in terms of who will retain ownership and of the leading product suite and who will take, if you like, the lion's share of earnings out of any sort of innovation. And we just sort of look to the next slide. I guess one thing that, makes me, confident in terms of the ability for, if you like, the large tech companies as a group to take that profitability, the productivity dividend, which we're going to enjoy from AI, is if we look across all of the leading AI venture capital firms, they all have cornerstone investors within that sort of big tech ecosystem. And there's some symbiosis here. Those AI companies, they need the capital, they need the cloud infrastructure to be able to build out their models. And big tech obviously are able to use these AI tools as bolt-ons or adjuncts to their current products and services and really monetize these solutions. So I think there's a lot of risk on betting on an individual stock, particularly stocks which are priced somewhat for perfection. But by holding the basket of stocks in totality, for example, through NASDAQ 100 index, that's I think an attractive way to play basically the build out of AI. If we just sort of flip forward to the next step, and really it is important to note that AI is really just the latest I guess development within the growth of NASDAQ companies and the latest area of innovation. And we look at a company like Microsoft, or indeed if you look at the NASDAQ as a whole, these companies invest roughly 7 times the amount in R&D and therefore innovation than the rest of the US equity market. And they tend to invest in these new areas of structural change. And that's what drives that compounding revenue growth over time. And why they have been leaders for such a long period of time, AI is simply the latest iteration of this trend. And just to follow on from that, on the following slide, the people are asking about the performance of the NASDAQ and NDQ out and NASDAQ fund this year. I think what we're suggesting is what you are looking for is that the market has priced in exceptional earnings and revenue growth this year. At every earnings announcement, expect some volatility depending on whether these companies can in fact deliver on what is anticipated. We are starting to see an impact of AI. It is important to note in the large tech platforms, and the place that we're seeing that is in particular in their cloud businesses, their revenue growth in cloud businesses. So for example, Microsoft cloud businesses grew by about 30% this last quarter. 6% of that was attributed to AI. So this is where you're going to start to see monetization of the cloud, is these large cloud platforms. You see the names down the bottom there. And really, these are fundamentally the most important growth engines and have been for some time for the likes of Microsoft and Google. And for Amazon itself, the majority of their earnings come from their cloud business. So that is where you're going to see that play through. And that's what we're looking for in terms of growth of a particular business line, revenue and earnings within the NASDAQ. But, I think, it is fair to say that if we just want to look at perhaps second order winners and areas that perhaps haven't been impacted, to the same degree in terms of, reset of valuations, there are other places to look outside of the Magnificent Seven or outside of, indeed the NASDAQ as a whole. And the first one, just flipping to the next slide, is really the cloud computing ecosystem as a whole. And cloud computing includes those hyperscalers that we sort of talk about, like Microsoft and AWS, Amazon, but it also includes the full cloud stack, which includes the infrastructure as a service providers, and as well as the software as a service providers that have software solutions that sit on cloud computing platforms. And indeed, within that software part of the stack, software as a service, companies, whether it be someone like Salesforce or Wix, someone like Salesforce, they are essentially a data analytics company. They collect a wealth of data for their clients, their CRM solution, and using AI tools are better able to provide good insights. And they've been able to embed themselves in businesses globally. We're seeing an uptake of, we're just talking about this before we're on air today, an uptake of AI tools within software as a service platforms like Salesforce. So cloud computing is an area where the whole ecosystem stands to benefit from AI, and not everything has been repriced to the same degree as those Microsofts and Amazons. It's also important to note that even before we got to AI, digital data globally was growing at 60% compounded. The growth in digital data, that digital data needs to be stored somewhere. Where does it go? It goes on the cloud. So strong tailwinds for cloud computing. Looking at perhaps another thematic within the Betashares suite in terms of funds, if we flip to the next slide there. So we see here a global robotics and artificial intelligence ETF. Now, I think there's some interesting developments in terms of geopolitics here too, where a need for reshoring or has led to fiscal policy and industrial policy in the States that has encouraged the build out of the construction industry, or if you like, the renaissance of the US construction industry, manufacturing industry. And we can see that in the statistics as to the amount being spent on building new factories. These factories obviously will employ more people, blue collar jobs, but they are going to need a degree of industrial automation. And names like Kiernan, Monik, ABB, these are companies who produce the industrial robots that are critical for the build out of these factories. But what's sort of also interesting in terms of the intersection of robotics and AI, if we go to the next chart, I've got like just a bit of a visual here, thinking about, yeah, that's the one. So if we look to the left here, what you see, those orange machines are your traditional industrial robots. They typically work in what's known as a high volume, low mix capacity. So they do repetitive tasks on a production line, large scale manufacturing. And if you look on the sort of far left side, you'll see sort of a perspex wall. That's the work cell, because those robots don't have situational awareness. They don't have sensors. And if a human walks in their path, unfortunately, the robot's going to kill them, right? These are big machines. They're very cumbersome. Now, where AI has been very interesting in the development of the robotics industry is on the right-hand side. These are cobots. Cobots are collaborative robots, and they're designed to work in an environment together with humans. And this means that we can look to implement robotics in a range of other industries where they weren't previously used. And just one simple example is small scale and bespoke welding. For example, in the States, it sounds kind of simple, but in the States, there's a shortage of welders, of human welders. And we're seeing the use of cobots, which are robots that have AI-enabled sensors and vision and touch to be able to work in conjunction with a human for more productive outcomes. And that's addressing a skills shortage there in that particular industry. So there's these second order winners from the build out of AI. And the final one I just thought I'd touch on just briefly, and I'm definitely happy to talk more about any of these areas in the Q&A section. If we flip forward to the next slide, is cybersecurity. You may well be familiar with HACK, our global cybersecurity ETF. It's in fact one of our larger funds. It's performed exceptionally well over its inception over 7 years ago. And I don't think that this structural theme is going away anytime soon. And in fact, you would have to say that the development of large language models only increases the ability for a cyber criminal to basically execute a threat at scale across a large surface area. We're obviously seeing the emergence of deep fakes, and we know the trust factor with deep fake videos is far greater than other forms of communication. So AI is essentially creating more tools that make it easier for someone to carry out a cyber attack. But interestingly, if you think about what some of the fundamentals are of AI, they also enable better cybersecurity solutions. And so, basically AI enables the processing of huge amounts of data and, essentially the investigation or pattern recognition in real time. And that's essentially what you are doing in various areas of cybersecurity, like threat detection, or, for example, penetration testing, if a company wants to test its own defenses to ensure it doesn't have any vulnerabilities. These are areas where AI solutions, so CrowdStrike have, for example, Charlotte AI, are being used and rolled out by these cybersecurity leaders, and we see that as a strong tailwind. If we flip forward to the next slide too, I mean, it is one of the important things to look at with sort of any kind of IT solution, which is particularly oriented towards the corporate market, is where are chief information officers prioritizing the spend of their IT budgets. And for a long period of time, many, many years, the number one area of increased spending has been security software, which is essentially, or information security, which is essentially spending on cybersecurity. It still is within the top 3 priorities in the most recent survey, which has been done by this organization, Morgan Stanley. They survey CIOs globally to see where they're looking to spend money. But we have interestingly seen that AI now has crept up, and we're also seeing that as a priority. But if we looked at the second chart there, so the first chart is your areas of projected increase in spending. The other important thing as a chief information officer is, if my budget gets tighter, where am I going to cut money? And the area of IT projects least likely to get cut is basically cybersecurity, security software. So the environment is very strong in terms of corporate spend. We're also seeing, as well as the advantages of AI in cybersecurity solutions. If you want to contract with the US government now, the requirements around cybersecurity are much greater than what they used to be. So it's becoming mandated that you need to spend on cybersecurity. And AI is just one development. We're going to see at some point in the future quantum computing really create a whole new bunch of challenges and require new solutions in terms of making sure that the encryption that we currently use today isn't vulnerable in that world. So they're three areas of the economy that aren't necessarily as I guess talked about as widely in terms of tailwinds for AI, and haven't really repriced to the same degree as a stock like Nvidia. I'll end it there.
Well, thanks, Cameron. That was really useful and informative. So now we're going to move to Monik, who will be discussing the active investment approach and how AI is so transformative. So over to you, Monik.
Great. Can you see me? Perfect. Great.
Yep.
Great. Thank you. Yes. Transformative and exciting. Absolutely. If you look at this chart here, this is the forecasted growth in generative AI revenues over the next 8 years. And it is estimated at this stage that the market size in terms of revenues will reach around $1.3 trillion. And Gen AI will represent something like 12% of total IT spend from the current 3%. So there's no doubt there is a significant runway of growth opportunity available for those companies who are well positioned in that space. Now, ChatGPT interestingly reached 100 million customers in 2 months. So this is the fastest ever growing consumer application in history. And I think the important message, if you look at the general trends of the last sort of 20 years and the adoption of technology, is that the time for market adoption for these technologies has continued to compress significantly. And what this does is it actually obviously creates some really interesting opportunities, but also a lot of threats when it comes to picking stocks. So previous winners can quickly become very disrupted and new winners can quickly emerge. So one needs to be very constantly vigilant and really on top of the trends and making a very important evaluation as to how these emerging trends are impacting different businesses. So it's very important to appreciate that we tend to, and this is one of the key tenets in technology over time, we tend to appreciate, or rather, it is important to appreciate that we tend to overestimate the effect of technology in the short run, but really underestimate its impact in the long run. And so all technologies do go through a hype cycle. And the real skill is actually knowing when to buy into the technology, how much of the portfolio you should have in the portfolio, how much of the portfolio you should have exposed to that trend, and when to sell. Next slide, please. Great. So as I think it's clearly evident, it is transformative, and there's probably no better person out there to rely on in terms of its profound impact than Bill Gates, who certainly considers AI to be the most transformative technology ever, and really it's going to have a profound impact. And as he puts it, it's going to revolutionize various aspects of our lives. So it's really going to have an impact across a broad range of areas. And if you go to the next slide, please. As you can see here, it's going to have an impact across a broad range of areas. We tend to have a very narrow view at the moment in terms of where the AI impact's going to be. And clearly, the most obvious areas has been the enablers, we heard a little bit about NVIDIA a bit earlier on, but I think the beneficiaries in AI is going to be much, much broader, and really the beneficiaries are going to come from those businesses that adopt and integrate AI into the business models and make it really part of their DNA. And you can see here the range of industries that are going to be impacted, and I might just focus on two. So if you take healthcare for an example, as an example, heart disease continues to be the biggest killer out there. And AI has already shown to offer improved diagnostic accuracy, really good innovative risk prediction, and improved treatment outcomes in the heart or cardiac space. Specifically, artificial intelligence has been used to develop algorithms that can identify and classify heart disease with a high level of accuracy, including very difficult to diagnose cardiac conditions. And it can also detect subtle changes and abnormalities that normally gets unnoticed by professionals and by traditional means. And what this means is that you're getting a much more accurate and efficient analysis of medical images, for example, such as echocardiograms and cardio MRI scans. I think what's also additionally very exciting is that it can also, because it can process such vast amounts of data, patient data in a very short period of time, it actually allows for the identification of patterns that predict the likelihood of developing certain heart diseases. If you then move to another example, we'll take the finance area as an example, and MasterCard specifically, they're already using AI, particularly to prevent fraud and reduce false declines, which can really be annoying, particularly when you're on a holiday overseas. You're looking to pay for something, you're in Indonesia or you're in Bali, and your transaction gets rejected. And so what they've done is they're employing real-time analytics and machine learning algorithms to analyze, a continuous stream of transactional data that you've been doing, enabling much more accurate fraud detection and really a significant reduction in false declines. And what this has done for MasterCard and a lot of the other companies is actually really improved the customer experience. If you go to the next slide, please. So why should every company integrate AI into their business model? And I think there are really two main reasons. And I think some of them are becoming fairly obvious through the examples I just went through. The first is that AI can clearly process and analyze data far more quickly than humans. And what this does is it leads to insights that provides a competitive advantage in the marketplace. And I think the second reason why AI is so important is because if you think about the last 20, 30 years, it's really been a period of innovation. I think we're actually moving into a golden period of innovation moving forward. And what it allows is those businesses that embrace and integrate AI and make it part of their DNA, it really enables them to bring newer products and services and solutions to customers much, much more quickly. So most investors are aware, I think, of who the obvious winners are. It really is the chip and cloud companies at this stage. But we consider that there are other opportunities that are far broader, particularly in those businesses that have really those very large proprietary data sets, particularly when privacy, security, and compliance become really major issues. Also, using these large data sets also avoids the significant issue of hallucination, which is when AI models such as ChatGPT and Gemini generate incorrect information but present it as if it was a fact. So if you go to the next slide, please, I'll take you through some examples of those companies that have these large proprietary data sets that are so indispensable to the customers that are using their product or services. So if you take Adobe as the first example here, they really have established themselves as the indisputable standard in creative software. I think everyone I know who is involved in that space has a subscription to Adobe, so they have a very large installed loyal database. and they've really commanded recognition and reliance from professionals right across from graphic design to photography, videography, web design, and publishing. So it really is in an incredibly well positioned to benefit from AI. Now, about a year ago, when AI came to the fore, the initial market reaction was that Adobe was going to suffer, and the share price actually fell quite significantly. But as I said, customers are increasingly looking for a safe, compliant environment to be operating where they know they're not breaching any copyright rules. And so when Adobe introduced their Firefly offering, which is their generative AI offering into the marketplace, which was a competitor to the DALL-E and Midjourney at the time. As I said, the market took a very negative stance, but as you can see here, within a very short period of time, 4.5 billion images were produced within the first 8 months. And as I said, what makes it such a highly appealing offering and a necessity for any company, to be honest with you, is that they can now profit from using generative AI whilst trusting their reputation and reliability. So again, this is where the large data set that Adobe has actually gives them a real competitive edge. And it actually sits behind what I consider to be the general AI-based investments that most investors are investing today. If I look at the second example, we've got RELX. Some of you may have heard of it, may not have, but they're actually a global leader in providing scientific, technical, and medical information to researchers and industry professionals, really helping them to access the latest findings and stay up to date with advancements in their respective fields. So if you look at the legal profession, a lot of the lawyers use the LexisNexis database, which, as I said, RELX is a leader in providing legal documentation. And what they have is 139 billion legal documents, over 1.9 million new legal documents are added daily, 71,000 sources, generating 137 billion connections. So an enormous amount of data that sits there. And, RELX are now using AI to deliver a really seamless and highly directed information to the legal professional. If you look at the final example, which is Booking Holdings, obviously a leading global online travel assistant. I think we're all familiar with it. I've used it at least once in the last sort of 12 months. Now the travel megatrend, that's one of the megatrends we've invested in, continues to surge forward. But in today's market, the surveys are clearly showing, I think we all know, we're all looking for a much more personalized experience, and the data that they've collected, having booked 895 million rooms in 2022, it's likely to surge past 1 billion rooms this year. They're really on a strong position to benefit from AI and again provide a much better service to their customers. So, as I said, there's the obvious places to invest, and we think the range of opportunities actually sits beyond the classic investments, and certainly in a very attractive area to invest in is those companies that have these very large proprietary data sets. Go to the next slide, please. So Insync, you can see from this chart here, we invest across megatrends. There's actually 16 here. Many of them actually are non-technology. So we've invested in areas such as the pet humanization, the household formation, and the experiences megatrend. And our focus is really on finding companies that are benefiting from these long-term secular trends, but they should also be very highly profitable and cash generative. And what that does is having those attributes in place enables them to actually deliver sustainable earnings growth. And really over time, when you really boil investments down to what really drives, good long-term share price returns, there's actually a very strong correlation between rising share prices and sustainable earnings growth. So the key really here is that, we're handpicking the stocks within these mega trends. We do not believe that a rising tide lifts all boats. And if you look at the fullness of history, only 4% of all stocks have actually contributed to most of the market returns over the last 100 years. So really, we think stock picking is very, very important. I think the other point to make here is that, we believe obviously AI is very important. We discussed the size of the market earlier and how impactful it's been across a range of areas. But we think it's very hard to classify it as an individual megatrend because its impact needs to be clearly understood across different stocks and sectors, right across those megatrends. And really understanding its impact is what will help us identify who the winners are going to be and really avoiding the losers. Can go to the next slide, please. So as I mentioned earlier, it's important to appreciate that we do tend to overestimate the effect of technology in the short run. But we do definitely underestimate its impact on the long run. And this is not something that I came up with. It's actually come up. It's actually known as Amara's law. And the consequence of that is that we do get very excited by these new technologies as they come through, and they do create hype cycles and significant overvaluations. And that's what this chart shows is when you do get bubbles and you do get hype cycles in geographies or within certain asset classes, or certainly within technology, when the bubble falls, the subsequent falls can be very, very significant. So I think as an active stock picker, we're certainly very excited, but really our job is to manage the risk. And a critical part of investing in AI, which we think has got a very long runway of growth, is that there are going to be cycles of overvaluation and hype, and we perhaps are in the middle one at the moment. So a critical factor is, as I said, is managing the risk. It's knowing when to buy the stock, how much of that mega trend or that exposure you want towards that trend, and when to get out of the portfolio or when to exit the position. And this is where machine learning and AI really becomes really quite important, because what it does is it takes the human emotion out of it, the excitement around the hype, the overconfidence which comes when things are going well for you. And what the machine does is it's an unemotional system that basically tells you things are getting expensive, things are getting overhyped, and it is time to reduce your exposure. So with that, I'm happy to hand it back to the moderator, please. Thank you.
Well, thanks very much, Kotecha. And now we'll move to some questions and answers. But I'll kick off with some of my own questions. And one of the interesting things I've found when interrogating people like yourself, Kotecha, and Cam, it's basically that where I expected that there would be a lot of interest in some of the novel startups and everything in AI, when I've interviewed fund managers both in Australia and overseas, it's basically been a case of sticking with the dogs they know, really. It's been a case of the big players, Microsoft, Amazon, some of the companies you've actually mentioned, and I guess they've got good balance sheets and good track records. What's your take on that? And Cam, you to start, I guess.
Yeah. I mean, I think as was sort of shown on one of my slides, the interesting point around the development of, for example, a large language model is the amount of resources required. So, where there are like, Databricks or Amorphic or some of these AI startups where they do have leading technology, they might be an interesting investment opportunity. Frankly, a lot of them are, pretty difficult to invest in if they're VC, but they are essentially, having these cornerstone investments from the large tech companies. And if you sort of look at the flow of cash, in a way, you've sort of got, VC investors giving money to a VC company, and that VC company is then essentially giving that money to someone like Google or Amazon or Microsoft, because they just are reliant on that infrastructure those large tech providers can give you. And frankly, those large tech providers at this stage of the game are best placed to monetize that opportunity. So that has been the place to play. That won't I don't think that necessarily is, there are threats to investing in those large tech players. For example, if they do dominate, and if you look at their share of total, capital market income, you might find some antitrust concerns start to arise. You may find that, for example, open source models start to disrupt the models which are tied to Microsoft and Google, like Gemini and OpenAI. So there are, potential threats, but they certainly start off in a very strong competitive position due to their capital, due to the infrastructure they've already built up, and that's why they're winning.
And Monik?
Look, I think we all know where the obvious places are to invest, and certainly in my conversations right across the board, mums and dads to brokers to advisors, is that everyone is fully invested in this space at the moment, and it's well understood and well known that who the obvious beneficiaries are. And I think the real risk here is really where I finished off when I went through the slide pack, is that, yes, in the long term, some of these stocks will end up winning, but during that process, you might have some significant, what we call drawdowns, or significant falls in share prices, because very high expectations have been built into the current share prices. So these companies may well deliver in the fullness of time, may do. And certainly when you looked at the dot-com bubble, which I'm familiar with because I sort of worked my way through that, it took many, many years, in excess of 10 years actually, to really start working out. And even now it's still working its way through the last 5 years as to who the winners from that had been. And along the way, there were a lot of companies that fell quite significantly. So one has to be very vigilant around valuations and excessive optimism. And whilst I think some of those incumbents are incredibly well positioned, I don't necessarily think that the share prices, all of them, will continue to do very well from here. And really, you do need to handpick them and work out which ones are likely to be the winners going forward. It's an ongoing process.
Well, we live in an interesting world at the moment in all sorts of ways, and as one of our questioners has asked, that and pointed out that there's been no discussion of Chinese use of AI, and we were basically, going to talk about geopolitics and the other factors at play at the moment, and goodness knows, geopolitics at the moment are intensely interesting. So I think from a geopolitical point of view, and starting with you, Kotecha, what do we think is happening in terms of geopolitics and AI, and where that brings into it, and I guess particularly with respect to China, which is actually being quite dominant in a number of tech areas like 5G and certainly in electric cars.
Yeah, so countries are obviously looking to achieve AI dominance, and so it's led to sort of the weaponization of AI, and certainly we've started to see imposition of significant export controls coming through. It's going to have a profound impact in the AI space without a doubt, because one needs to understand how individual countries are going to respond and protect their IP that they've created, because it is seen as a weapon in many instances, and you need to understand the regulatory environment that's actually evolving in each of the countries. And this is where, again, an active approach is important. It's not a case of rising tide lifting all boats. There's multiple factors at play here, and geopolitics and regulations are certainly big dynamic factors that when you're investing in the space, you need to understand, and you need to look at the implications for each of the companies, and whether they're going to benefit or they're going to lose out from what's occurring. So absolutely. And the Chinese are obviously catching up a little bit, but they're still way behind. I mean, the IP required, they're now coming out with so the leading edge is 3 nanometers, and they've come out with a 5 nanometer solution. not necessarily using the latest technology out of the US, but they've done it their own way, and so obviously they're trying to build independence in that whole process. But for them to achieve the levels that have been achieved in the US will take a very, very long period of time. So you can see why these export restrictions have really come into place in the last year.
And Cameron, your view on that? You're on mute, mate.
Yeah, thank you. Yeah, just for a counterpoint there, I think it's sort of interesting to think about the sort of I guess the other implications that the chip export restrictions have had for basically Western chip manufacturers exporting chips, the cutting edge chips to China. We saw that, for example, Huawei produced a smartphone last year using basically second-rate chips that basically had the same speeds as an iPhone with the best-in-class chips. So it is one of the challenges that, if you like, the Chinese face from the development of AI is with the I guess the less access to hardware or high quality hardware, their need to build out their algorithms and therefore the AI better to solve these problems. And we know that China, for example, has nearly twice the number of PhD science and STEM students, PhD candidates graduating every year versus the US. They are spending a lot of money in this space. I think they will challenge it at some point. And we are also seeing, for example, the concept of sovereign AI, where governments have essentially said, well, at the moment, this is basically a private sector phenomenon. The resources, the infrastructure is all sitting in private sector, and governments will need to have some control as AI becomes more important and are likely to build out their own resources independent of the private sector too. So again, that's probably another area of spending, and it probably benefits NVIDIA and ASML and the chip manufacturers. But it is an interesting dynamic to see how this becomes more and more important for Chinese, US, and just general global relations.
One question here from Luke Drew, which actually aligns too with some of the stuff we'd pre-prepared, but I'd love to hear our speakers' views on how AI impacts their own roles in investment management. How quickly do they expect AI will dramatically displace the need for human investment analysis? And I'll let you deal with that, Cameron, to start, and then we'll move on to Monik.
Yeah, well, we are hiring, in the process of hiring a data scientist within my area. So clearly it's having a role, and we are using tools that are AI enabled and to assist us in terms of what we do. I think that I see it hopefully as a way to enhance what we're able to provide in terms of insights and the way that we think about, predominantly my role is around portfolio construction across asset classes, as well as individual building blocks. So using AI as a tool to enhance what we do, ideally rather than replace my own role. But that's, the other aspect in terms of, we get a lot of questions about AI-powered exchange-traded funds. So essentially, using an algorithm to build a portfolio which an ETF invests in. To date, the efforts that we've seen in terms of those globally, I don't think they've necessarily delivered on the promise there. Machine learning in particular has been around for a long time in asset markets, and if you look at companies like Renaissance in the US, hedge funds that have enormous resources have been able to use these tools. But I think a lot of those tools for the time being really work in really short-term trades or high-frequency trading rather than maybe long-term investing. We'll look to see how that plays out over the long term. Maybe Monik and myself can be replaced, but if you're a long-term investor, for the time being, we see AI as tools to help us do our job rather than entirely replace.
Monik, I regard you as irreplaceable, mate, but what's your own view?
Thank you, I appreciate that, and obviously I would agree with you. But Look, we see it very much as a collaborative approach here between humans and machines. So it's really, we're already doing it. We're using it as a co-pilot. And, you know, what the human expertise can do is it can really challenge conventional thinking. So it gathers the information, you know, from company management. You know, we build our buy sell thesis on a stock. We can communicate the investment rationale. But what we can't do is we can't process the massive amounts of data out there on individual companies. So, you know, we've actually built an algorithm internally to help us process all that fundamental data. There's so many data points there. And quite often I get very excited. You know, I love the narrative. We've gone through lots of narratives, like AI and cybersecurity. And look, it is very exciting, and there will be winners within that. And I've done that, and I've come in and I've gone, oh, you know, I'm really excited about this stock, and I've, you know, done the work and I've built the investment thesis, and then we look at the data, and it actually tells me, well, no, it doesn't actually rank very well, because there's so many fundamental factors that drive what delivers good stock performance. You know, what drives its earnings. So you really, you know, by blending the two in a very collaborative way, we believe you can actually deliver, you know, better ideas, better portfolio decisions, and really outperformance. I mean, the other important aspect is around risk management. And we found, again, machines are much better at risk management than humans are. There's been a lot of work done in human behavioral science for the last 15 years. I think that's been fantastic. You know, we all have our biases. I have my own bias. We have our own cognitive biases. You know, it's recency bias, it's overconfidence. So when things are going well, like now, you know, if your portfolios are going well and you've got Nvidia and you've got Alphabet, and, you know, you're going, well, I'm not going to change anything. It's all looking fantastic. How many times have we been through that the last 30, 40 years? And what the machines do is, you know, they make fewer mistakes. They give very clear signals. So we actively use that, you know, to help us, as I said, not only to find opportunities, not only when to buy and work out how much to buy. We let the machine do a lot of that work. You know, it's all around the risk management framework, but importantly also when to sell.
Okay, well, we've come up with a couple of questions here around the use of AI, and one of the questions is whether, in fact, Betashares and AI are used, whether you guys are both using Insync and Betashares, or whether you are both using AI within your businesses. And I think you've both indicated that, in fact, you are. But would you like to speak to that? You're on mute again.
Apologies. Yeah, so we do, we use it for data analysis. We use it for a lot of the work we're sort of doing, you know, across operations. We don't specifically use it within the investment selection, or essentially the asset management side of things. So, you know, it is a very useful tool, but at this stage, we don't see, you know, a particular edge within the way that we manage money for stock selection, or, you know, investment selection, if you like.
Yeah. And Kotecha?
Yes, I mean, as I said, we are using AI, and we will continue to accelerate, you know, as AI continues to develop. You know, I think going forward, gone are the days when there's a bunch of guys, people, men, women, sitting in a room debating stocks and buying and selling and having a gut feel. And I'm sure there's some analysis. I think those managers will lose their edge. You know, information gets incorporated into share prices fairly quickly with technology. So really, you need to embrace it. So as I said, you know, we already have we call it, using machine learning, we call it an algorithm. It's allowing us to make better decisions around data, and then obviously with regards to analyzing and reading transcripts and and 10Ks in the US, going back over a period of time, looking for specific patterns, etc. We're now starting to implement AI to help us do that today.
Okay, fine. Well, we've just about run to time, so thank you both, and I'll hand back over to Toby. So thanks very much, and I'm sure we'll be talking about this again next year.
Yeah. No,
Thank you,
no.
Mike.
Look, thank you very much, Mike. And I do have one question for both Cameron and Monik, and that's given the sort of growth aspects that you've both spoken to, both directly in sort of AI participants and Monik, in your case, in the sort of second order or users of AI capability. I mean, where do you see exposure to this type of investment playing out in a conventional portfolio management sense? The advisor or the portfolio manager thinking, yeah, I want exposure, it should fulfill this part of my diversified portfolio.
Yeah, that's a great question. I'll go first if you like. As you rightly pointed out, exposures to this sort of theme, and we've talked about it as more than just AI as a single theme, but we are fundamentally talking about growth equities here. When we think about portfolio construction, we're obviously looking for balanced exposure, and we generally, we're talking to most clients, will adopt a core plus satellite approach. And so we might be thinking about how we're building that core equities sleeve and looking at, for example, our Australian equities, which we all know are relatively skewed to cyclicals. Every now and then a company pops up that's apparently tied to something like AI, like Appen, and unfortunately that stock didn't do very well in the end of the day. But our Australian equity market is quite value skewed. If I look at something, for example, like NDQ, which is our diversified exposure to NASDAQ 100 index, I think when you're thinking about a growth exposure, it can be very difficult, and all due respect to Monik, it's very difficult to, in fact, pick the winners over a long period of time, and that's why a broad market passive approach to something like the NASDAQ has performed exceptionally well, like exceptional investment over a long period of time. Now, you can look to blend in some of that growth exposure to complement your Australian equities within the core, or potentially combine, for example, quality growth with another factor like value, and think about how those types of exposures offset each other, how they behave in different market conditions, for example, whether we've got a hiking cycle or a looser monetary policy sort of environment. And that's really about the core. And then beyond that, if I'm thinking about maybe some of those, I guess, second order winners, like we talked about cybersecurity, they tend to be best used, in our view, as a satellite. So a smaller allocation, they will have more, if you like, theme specific risk. They tend to have lower correlation to your core. So they can be a bit more high volatility, but a great way to add outperformance potential in a manner where if you're not adding too much of them, you're not going to blow up you're not going to increase the portfolio volatility as a whole. You're going to keep it contained. So it's thinking about what can I bring in as core broad diversified exposures like NDQ, and then how can I use satellites for something which is going to be, obviously looking to add outperformance, but giving you something which is different to broad markets as a smaller satellite.
And Monik, as a diversified global equity manager yourself, how do you see this type of exposure fitting into portfolio management?
Yeah, I mean, I would be very cautious about having a specific AI exposure, because as I hopefully brought through in the messaging today, it's going to impact every sector. And really, companies that basically embrace and integrate AI into their DNA as early as possible, and I've given you some examples today, we think are going to be the clear winners. And that cuts across the growth and value space. I mean, growth, value, that's old style of managing money. I mean, picking cycles, anticipating where rates are going and buying, if you look at, there's been a lot of good work done that actually show very few companies actually outperform over the very long term. And there's actually been a lot of work that's been done that shows that thematic ETFs actually underperform very significantly. And that's the reality. I mean, I'm saying it as it is, because the most recent one has been hydrogen. Everyone got very excited about it during the renewables boom. And, that's down 50% and the market's up 20%. And we've seen what's happened to many other ETFs. And in fact, work has shown that within 6 months of launching a new thematic ETF, they normally go down because they're normally created at the hype of the cycle. And that's the whole point. So I think, as I said, with AI, I don't think there's a specific slither or it goes into it. It should be integrated into, regardless of your style of management. Even if you're a value manager, growth manager, whatever you want to call yourself, at the end of the day, you need to understand how AI is going to impact the stocks in your portfolio. And if you can find whatever value means, but if it's, we're valuation driven, but if the value is a style, there are companies within that space that are going to be leaders in AI, and they will do very, very well. So I think the more important question, if I was an advisor, would be asking the fund manager, how, regardless of style, how are you thinking about AI in your portfolio?
Right. Look, thank you very much. And both Cameron and Monik, thank you very much for a fascinating set of presentations on AI and its impact on the investment universe. So I hope for those of you who've joined us today and Tuesday and Monday, you've found this overview of AI and its impact on advice, portfolio management and investment management interesting. This is a topic and a theme which is not going away. It's affecting all of us. We're all starting to make use of these tools, and as both Cameron and Monik have said, it's a technology which is going to radically transform what we do and the services that we're able to offer. So thanks for joining us today. Let me just remind you of the couple of things that we have coming up in March at our Portfolio Management Conference, July Advice in Action. So thanks very much to all of you who've joined us, and we'll look forward to seeing you at future events. Thanks.